History's most famous financial advisors are a varied lot. They include successful investors who share their knowledge with the masses, television celebrities who write books, and swindlers too. Welcome back to another episode of Facultive Station. Get involved and join the community by subscribing to the channel so you never miss any of our latest uploads. In this episode, we're going to be taking a look at 10 of the most famous financial advisors. Let's get into it. Benjamin Graham. Benjamin Graham is known as the father of value investing, which involves identifying and buying undervalued stocks that had the potential to grow over time. After graduating from Columbia University at age 20, he started his career on Wall Street, eventually founding the Graham-Newman Partnership. After employing his former student, Warren Buffett, he took up teaching positions at his alma mater, and later at UCLA Anderson School of Management at the University of California, Los Angeles. To calculate a company's intrinsic value, his approach eschews trends and hot ideas and relies instead on diligent research, thorough financial analysis, and patience. Standard concepts today, but revolutionary when he introduced it in the 1930s. Graham's disciples include many of the most successful investors of the last 70 years. His 1949 book, The Intelligent Investor, remains a must-read for all asset managers and stock traders, whatever their investment approach. Warren Buffett. Investor Warren Buffett, the Oracle of Omaha, is one of Graham's most famous followers, and his remarkable track record, openly attributed to Graham's principles, has helped keep his mentor's name alive. The one rule of Graham's that Buffett does not always follow is to diversify. He often prefers to concentrate investments in companies. After providing significant profits to his original partners, Buffett went public with the acquisition of Berkshire Hathaway Inc. (BRKA) in late 1964, making it the holding company for his other investments. A $1,000 investment in Berkshire Hathaway in 1964 is worth more than $20.6 million today, indicating an annual growth rate of close to 20%. Buffett became a billionaire when Berkshire Hathaway began selling Class A shares on May 29, 1990, with the market closing at $7,175 a share. In 1998, he acquired General RE as a subsidiary in a deal that presented difficulties, according to the Rational Walk investment website. Underwriting standards proved to be inadequate, while a problematic derivatives book was resolved after numerous years and a significant loss. Peter Lynch. Peter Lynch managed the Fidelity Magellan Fund, FMAGX, from 1977 to 1990. During his tenure, he provided investors with a 29% annual compounded rate of return. After leaving the fund, Lynch wrote 3 best-selling books detailing his investment philosophy and stressing that small investors are capable of doing better in the stock market than large asset managers. He coined a number of well-known mantras of modern individual investing, such as to invest in what you know and 10-bagger. Lynch has been described as a legend by the financial media for his performance record. His most famous investment principle is invest in what you know, popularizing the economic concept of local knowledge. Since most people tend to become experts in certain fields, applying this basic invest in what you know principle helps individual investors find good undervalued stocks. Lynch uses this principle as a starting point for investors. He has also often said that the individual investor is potentially more capable of making money from stocks than a fund manager, because they are able to spot good investments in their day-to-day lives before Wall Street. Dave Ramsey. Dave Ramsey is a radio and television personality who has written 6 best-selling books. On The Dave Ramsey Show, a syndicated radio program, he takes calls from people with financial problems and talks them through the solutions. His underlying philosophy is debt-free living. He counsels people on concrete steps to get out of debt and never get into it again. At age 18, Ramsey took the real estate exam and began selling property, working through college at the University of Tennessee, Knoxville, where he earned a Bachelor of Science degree in finance and real estate. By 1986, Ramsey had amassed a significant portfolio, worth over $4 million. However, when the Competitive Equality Banking Act of 1987 took effect, several banks changed ownership and recalled his $1.2 million in loans and lines of credit because he was over-leveraged. Ramsey was unable to pay and filed for bankruptcy in 1988. Suze Orman, an Emmy Award-winning television host, her The Suze Orman Show ran for 13 years on CNBC, and best-selling author of multiple books, Suze Orman is known for the brash and pushy style that she delivers with a smile. One of her trademarks is to explain to people wanting to make a major discretionary purchase that they just can't afford it. Her appearances on The Oprah Winfrey Show and The Today Show, as well as a column in O Magazine, have made her one of the most famous and recognizable financial advisors of all time. Jim Cramer. Hedge fund manager turned TV host, Jim Cramer is known for his ability to have an opinion on any stock or economic matter at a moment's notice. His CNBC program, Mad Money, is a loud and very fast-paced show. In the midst of the seeming chaos, Cramer dispenses solid, practical information aimed at teaching individuals to think like financial pros. He also has a website, TheStreet.com, which provides Wall Street-related news, commentary, and advice. In a December 2006 interview, Cramer described activities used by hedge fund managers to manipulate stock prices, some of which have debatable legality and others quite illegal. He described how he could push stocks higher or lower with as little as $5 million in capital when he was running his hedge fund. Cramer said, "A lot of times when I was short at my hedge fund, when I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures." He also encouraged hedge funds to engage in this type of activity because it is a very quick way to make money. Robert Kiyosaki. The author of the best-selling Rich Dad Poor Dad book series, more than 30 million copies sold, also conducts personal finance and real estate seminars, franchised through his Rich Dad company. His basic philosophy is, create passive streams of investment income and grow them until they can support you, without you having to work. Kiyosaki's financial and business teachings focus on what he calls financial education, generating passive income by focusing on business and investment opportunities such as real estate investments, businesses, stocks, and commodities, with the goal of being able to support oneself by such investments alone and thus achieving true financial independence. He has a series of authors and other experts that he often cites as Rich Dad advisors on real estate investing, financial planning, and avoiding taxes. Ben Stein. The well-known actor and host of Comedy Central's Win Ben Stein's Money is a former economist and law professor. His Hollywood persona makes him a sought-after guest on various financial news shows. His advice and opinions are straightforward and to the point. He is best known on screen as the economics teacher in Ferris Bueller's Day Off, as the host of Win Ben Stein's Money, and as Dr. Arthur Newman in The Mask and Son of the Mask. Stein co-wrote and starred in the 2008 propaganda film Expelled, which portrays the pseudoscience of intelligent design creationism as if it were a scientifically valid alternative to Darwinian evolution, and alleges a scientific conspiracy against those promoting intelligent design in laboratories and classrooms. Stein is the son of economist and writer Herbert Stein, who worked at the White House under President Nixon. Charles Ponzi. Charles Ponzi did not invent the pyramid scheme, but his version was so audacious that all subsequent scams of a similar nature bear his name as Ponzi schemes. In 1919 to 1920, under the heading of a firm called Securities Exchange Company, he promised returns of 50% in 45 days or 100% in 90 days. Due to his reputation for success in the arbitrage of post-stamp coupons, investors were immediately attracted. But instead of actually investing the money, Ponzi just redistributed it and told the investors they made a profit, while pocketing a significant portion of the proceeds for himself. Bernard Madoff. Bernie Madoff was perhaps Charles Ponzi's most infamous disciple. In the 1970s and 80s, Madoff ran a legitimate securities firm and was chair of the NASDAQ for 3 years in the 90s. He used this operation as a front for the creation of a hedge fund division that, while pretending to use sophisticated trading strategies, was a total farce. He simply deposited new funds into a single bank account that he used to pay existing clients who wanted to cash out. Still, the returns and his reputation seemed so good that thousands of wealthy and famous people, and even other hedge funds, invested with him. It was only when the 2008 financial crisis caused Madoff to be unable to keep up with redemptions that his operation was exposed as a $65 billion Ponzi scheme. Madoff died in prison on April 14, 2021. With that, we've reached the end of today's episode all about 10 of the most famous financial advisors. Can you guys think of any other famous financial advisors that we didn't include in this video? Get involved and let us know in the comment section down below. If you enjoyed this video, remember to leave a thumbs up. Plus, if you want to see more fantastic finance and accounting content just like this, remember to subscribe to the channel and check out our other socials such as Instagram and TikTok that are listed in the video description. As always, thanks for stopping by and watching. See you again soon in the next one.